Hello, everyone, and welcome. I'm Eddie, part of the strategic team at Moat Investing, and today we are thrilled to share something that our community has been asking for a very long time. Together with Sakib, our senior equity analyst, we are introducing the iMaps Value Edge ETI, a brand new investment vehicle that allows you, our followers, to invest alongside us, following the same principles and stock ideas we have shared now for years. This ETI is made possible thanks to our collaboration with From London Partners Management. We should mention them. They are a regulated portfolio management firm based in Malta, and we are proud to have them as our partners, overseeing all the operations. They are managing this product as they do always with the highest standards of compliance. And this is, guys, a pre-launch. This is an exclusive, right? A premiere. The phone is already listed and visible on platforms like Interactive Brokers with this ISIN number and this ticker, but it will be officially active in the upcoming days. So we're giving you our online community, as always, the premiere here. And but what is an ETI? Is an exchange trade instrument, and think of it as a listed securitized investment vehicle. It's similar to an ETF or a mutual fund, but I would say with greater flexibility and also transparency. We are currently listed in Germany on the Stuttgart Stock Exchange and under this ISIN and ticker that you will also have in the description, so you can copy and access it. You will be able from now to be it from most brokers that have access to the European market, like Interactive Brokers, and your shares will be fully regulated, bankable, and held in your brokerage account, just like any stock or ETF. It's an ideal, I would say, solution for those of you who have followed us for years on Seeking Alpha, here on YouTube, on Twitter or X, also on Telegram. And you have always made questions about portfolio sizing, timing for entry or exit, reduce or increase the positions. And now you can do exactly as we do, but in a simple and passive way. We are, I would say, proud and very happy to share this news with you. Our investment approach, as we have built already a reputation on, is for high quality research, a deep respect for value investing, and a full transparency with our audience. If you check on Seeking Alpha on our articles, you will see that we go full deep on the companies we analyze, and we share with you everything that we see on the companies.
So, guys, some of the ideas that we are looking at, which I think might make way to our ETI, we will present those in this video, and then we will make a detailed video about the ones that actually do make to our ETI. The first one is Core Scientific. This used to be a Bitcoin miner, but they transitioned into an HPC company, into a high power computing distributor. It's a $2 billion company. They have long-term contracts with CoreWeave, mostly around 12 years, and they are around $12 billion. So CoreWeave is an AI hyperscaler. So they lease the compute power from Core Scientific and then further release them to companies like Microsoft and OpenAI. So this is a brief introduction of Core Scientific, what they do and all of that. We think there's a huge opportunity here because of two main things. The stock went down a lot based on two news. The first one was the DeepSeek announcement, and the second one was an article from Financial Times. Let me touch the first one. DeepSeek is an AI language model which was launched in China, which claimed to have used way less compute power than they are estimating in America, for example. That raised a lot of concerns about the HPC compute power demand. And remember, Core is selling HPC compute power, so lower the demand, lower will be their future contracts, and there's a high chance of contract cancellation with CoreWeave then. But this has been reputed by a lot of companies, by Nvidia, by Amazon, and Nvidia were just there in a conference like a week back. Both of them said that we still see a huge AI demand, a huge compute power demand. OpenAI said our data centers are melting because there's such a huge demand. So DeepSeek claims were refuted by almost all of the industry professionals. So I don't think this is a very big issue anymore. The second one was an article just before the IPO of CoreWeave by Financial Times, which claimed that Microsoft has scaled back some investments with CoreWeave. These claims were refuted by the CoreWeave management, saying that almost all of the CoreWeave contracts are non-cancelable, which can only be cancelled if there is some sort of performance or delivery issues. And even then, they'll have to report to CoreWeave 45 days prior to cancellation. So far, there was no report from Microsoft, uh, and there has been no other news platform that confirmed this story. So again, I don't think this is a very big issue. And also, CoreWeave, after this news, went on and announced a new contract, a huge contract with OpenAI. So CoreWeave does rely on Microsoft a lot. 62% of the revenue is coming from Microsoft for CoreWeave, and but the new OpenAI announcement tells you a lot about the AI demand and how diversified CoreWeave is becoming now. They want less reliance on Microsoft. There seems to be no issue. We have not seen a notice of 45 dispute from Microsoft, and it's been like a couple of months now. I don't think these are very big issues. Now, as a business model, well, we think that there is still a huge opportunity because the market is not fully understanding this thing right now. We have $12 billion contract in cores with CoreWeave. CoreWeave has contracts with OpenAI, with Microsoft. Then we have a lot of analysts dismissing the issues with CoreWeave as unlikely. There's a very good investor confidence, insider confidence. CEO was buying. And then if you see on the performance and the delivery issues, Core has delivered a couple of contracts beforehand, before the deadline date. So I think this is very good. So in conclusion, we have a very stable revenue stream for Cores. We have a growing AI data center demand, or CoreWeave is signing more and more contracts. So I think our NPV for the contracts of Cores with the CoreWeave was around $11. Then you add the amount of cash and the Bitcoin and take out the debt that they have, and then you add the valuation of the mining part. They still have some mining part from out of like roughly 1.2, around 1200 megawatts. Around 800 is in HPC, I believe, and the rest is still in mining. So we believe there is a very good upside in this one. Now, moving on to the next one. The next one is Vistry Group. Vistry is a $2 billion housing, is a house builder in UK. Vistry has been initially very successful for us. We have had a huge success with Vistry. It used to be a traditional house builder. We know that there's a huge demand for housing and affordable housing in the UK. Now, Vistry is focused more on the affordable housing side of it, and the new government, the Labour government, has announced a lot of initiatives to improve the housing, the house building and house construction in the UK. So we think that these are huge tailwinds for Vistry. Now, traditionally, there used to be a traditional house builder. They used to buy a huge plots of land, which was a very capital intensive thing to do. Then they acquired a company, a partnership based company, and then they announced a full 100% transition to the partnership business. Now, in the partnership business, that one is capital light. Don't invest a lot of capex upfront. Sometimes the land or some other part thing is contributed by your partner. Then you build on it, and then you distribute the profit as per your contracts. Now, this capital light transition, it was supposed to free up £1 billion in capital. Out of that, roughly around 200 million has already been returned to the shareholders in the form of buybacks. Moving on, these are some of the partnership models that Vistry operates in. First one is development-led, investor-led, and then limited liability joint venture. I will not go into a lot of details because this is just a whole new world in this video. So just to give you a hint what kind of partnership Vistry operates in, you can check it out here. Then we will, of course, give you a detailed explanation. And also remember, we have, for all of these talks, we have detailed research articles on Seeking Alpha. We will be posting their links in the comment section below and in the description. You can go and check out those articles as well. This is just a brief introduction. Now, the UK housing dynamic is something that made us really interested in this partnership business. There is and has been a huge acute shortage of housing in UK, especially the affordable one, for many years now. Even you can see here, there's at least a 4.3 million backlog on the houses. The Labour target is to deliver 1.5 million new houses in the next 5 years. Now that's really good. In the next 5 years, they expect to deliver these many houses. They have announced a lot of new laws which support the housing. You can now build on green lands. You can now build on brown lands, given you meet certain criteria. So I think the government needs these new houses. This was part of the election campaign, and this will prove to be a really good thing for Vistry. Now, why does this opportunity exist? Uh, there's always a catch. So Vistry ran it into a couple of cost overrun problems on one of their southern divisions. The cost overruns were not as uh, extreme as expected initially. The company did an external audit, a full comprehensive audit for all of the divisions, and they found only 50 million more uh, for the impacts of cost overruns. So cost overruns was one of the problems why the stock went down a lot, and then the management of the southern division was replaced. The hierarchy has been shortened now, so the lower the height of the hierarchy, easier it is for the people to work, especially the labor class, and to report everything. So all of these, they are trying to cope with all of these things. Now there was a profit warning as well. Part of that was because of the cost overruns. Other part was they were not able to complete a certain partnership houses last year, which impacted the revenue and the profit. All of that, the cost overrun, the inability to complete the houses, supposed to be a one-time thing. It's yet to be seen if it will stay one time. But this trades at around very close, maybe 1.1, 1.2 times the tangible book value. So we think it's very interesting. Now, tangible book value for the housing sector, remember, it's majorly composed of inventory. Inventory is just raw land, and it's at cost. Inventory is valued at the lower of cost, or NRV, according to IS2, the one that UK follow as well. So the ultimate value of that land once developed is going to be a lot. And even the work in progress inventory and the finished goods, it's way more than the cost of that inventory. So the tangible book value is worth a lot more, even if the company doesn't do anything more now. So we believe that the housing company close to or below a tangible book value is always very interesting. And we have actually learned that lesson with GRBK as well, which proved to be, when we looked at it, it was below the tangible book value, and then it shot up a lot. So that's why we think this is a very interesting idea. Next one is, you might be aware of this one. We've spoken a lot about it before as well, is a Sphere. $1.8 billion EV. Sphere right now presents a very, very attractive risk reward opportunity. There are a couple of reasons why, but Sphere is a venue in Las Vegas. Outside is all covered by the series, as you can see in the picture on the top left corner. There is a huge potential for advertising. There's a huge potential for growth here. There is some catalyst, for example, in the form of some sponsorship deals coming up, right? Advertising revenue to improve. The company is not yet profitable, but it's going towards profitability. And the company is very beaten down. It's trading below it cost to them to produce this beautiful venue. I think it costed like 2.2 billion or something like that. Now it's trading at around $800 million market cap. And so the other reason for the main reason for this company to go down so much in stock price, stock value is their segment called MSGN. MSGN is medical is medicine's sports garden network. Uh, this company is a sports network, and it's been going down in revenues, in margins, in cash generation, and everything. Now it didn't make any, and this one has like $800 million of debt, which thankfully is still only which only recourse to MSGN. Sphere is not impacted by that loan, but they ran into a problem. The company, the MSGN segment, went into a technical default last year, and it's been like 1 year now, and they just, this issue was resolved just last week. Yes, last week, when company announced that they are ending the forbearance period, the banks and the debt holders are getting a huge haircut on their debt, and the new one is only going to be $200 million. And then there are some payments of 80 million upfront, and then maybe 100 million after that. So the new debt deal seems to be very interesting for MSGN. MSGN was the reason why Sapphire went down, and based then when the news was announced, the Sphere went up like 10, 12, 13% on the news. And then MSGN also has lower licensing fees that it needs to pay to New York Knicks and Rangers. So we think MSGN segment will improve its operating profit, will improve its cash generation, which by the way was negative in the last quarter. So, and eventually we do believe that MSGN at one point will either be spun off or sold, because it does not make any sense to keep it with Sphere. Again, it's as I said, Sphere has a beautiful, beautiful business model. It's a one of a kind. It's and they are trying to grow now. They have announced a new Sphere based on a franchisee model in Abu Dhabi. They also said that we are in a talk with a lot of different markets for smaller size Spheres. So franchisee model is like really good. I mean, I think that's the best thing possible for Sapphire Entertainment right now. They don't need to spend any capex. They will have franchisee licensing fees from them. Then the content that Sapphire produces right now, only to display in Las Vegas, will also be sold in those other places in Abu Dhabi and other markets where they announced the new Sapphire. So the cost, the per content creation will go down, and the margin of the overall, the consolidated margin will go up. So I think these new announcements of Sapphire are highly positive for us as investors. Now, moving on to the next one, we have a special situation, as Eddie mentioned, that we kind of specialize in special situation as well. This is called net lease office properties. It's a portfolio of office properties, a small one, 400 million market cap. It's why it's a special situation, because it's a liquidation vehicle. NLOP, it was spun off only for one purpose: selling off all of the properties and distributing the excess cash to the shareholders. Now, why is it interesting? Um, NLOP right now is trading at around, I believe, 16, 17, yeah, 18% implied cap rate. The properties that they have sold so far are at 10% average cap rate. That's a huge, huge gap and a huge chance for the stock to go up. Now, previously they had some debt from the JP Morgan, some in the form of senior secured debt and some mezzanine loan as well. The first priority and one of the covenants of the debt was that they need to pay off the debt first, and then they can announce the dividends. Now it's a liquidation vehicle. So all of the excess cash that they generate, they need to distribute it to the shareholders. Now, last week, I believe, or the week before, they announced that they've sold some more properties and they have paid off all of the JP Morgan debt. It's debt free now. Not exactly debt free. Some properties remain which have a non-recourse loan to their names, but we're not worried about that. When we valued NLOP, we ignored the non-recourse companies. We assumed them at zero. Even then, we got a huge valuation, huge potential upside on this name. So now they have um, paid off of all of the debt. Company shockingly did not rally too much on the news because market doesn't understand that it's a liquidation vehicle. They see office properties and they run away. So I think that this is way more interesting now than it was before, because now you can expect the announcement of new dividends, special dividends anytime. Some of the risk factors here are that there's a duration risk. L- Longer the time frame for if they take longer, the present value of those cash flows goes down, and the more we have to spend in operating expenses. There's a thing of lease expiration. They have proven to release a lot of properties. They have proven their ability to release them, and so I don't think this is a very very big risk here. Of course, there is a tenant concentration risk here, but since it's not an operating business, I would also disregard this one as not. I have listed these risks which I've been questioned on before. So I don't think these risks apply too much on NLOP because it's a liquidation vehicle and it's not an operating vehicle. Now, in conclusion, we have roughly 65% upside here. The implied cap rate is around 18%. The actual one on which they have sold the property is around 10%. You seem to have a huge margin of safety here. Now, moving on to the last one, Peakstone. Peakstone is a stock that is a bit like NLOP because it used to be only office REIT. Then, when the COVID hit, a lot of their properties were impaired. They had to sell them at a loss because the work from home issue and all of that just killed the office real estate market. But then they announced a transition. They entered into the industrial REIT segment. Now, industrial REITs trade at much higher multiples than Peakstone, than the office REITs. Now, again, I would say it's a bit misunderstood by the market. Why? Because most of them still think that, okay, majority of the ABR is coming from the office, so it's an office REIT. But no, guys, as they sell the office properties, right, and they transition and invest more into industrial REIT, the multiple should expand. It needs to be recognized as an industrial REIT rather than a plain old boring office REIT. So that's why I think there is a very, very good opportunity here. It's not a liquidation play, but they're still liquidating their office portfolio in favor of the industrial REITs. Now, one thing that, again, one of the things that the market doesn't understand is not all of the office real estate is bad. Majority of the real estate that Peakstone holds are headquarters to companies, are research labs, are like data centers, or all of these things. And only 6% is exposed to the TAMI industries. Now, work from home really impacted the TAMI industry before than it did to the headquarters and all of those industrial companies. So these strategic facilities have way less chances to to for on the lease cancellation. I don't think these lease will be cancelled anytime soon because they need these facilities. They are strategic. They are headquarters. They are research labs. They are essential to those companies, and they are not impacted by the work from home situation anymore. Initially, they were. That's why they had a huge loss in COVID. But now only 6% is exposed to tech, advertising, and media and information. And by the way, we've seen a lot of trend reversal now. A lot of companies have a compulsory work from office now, and we think that this trend will even go in the Trump era. I think the work from office thing will pick up. Work from home is going down, so the office portfolio has a huge strength, even if they are selling it. In the meanwhile, it's a very good thing. Now the uh, industrial one is, I think, in the REITs is one of the best things out there. It's not, I mean, I've looked at shopping REITs being impacted by online shopping companies like Amazon, Temu, and all of those. I've looked at office streets, industrials, and then one other sector that I'll introduce again after this slide are the ones that are least impacted by these changing dynamics of the market. So their industrial portfolio, 49% of the ABR from this one is coming from the top US ports. And there is a huge chance of renewals as well. As I see that one of the leases was renewed at a 63% premium, guys. 63%. So that's a huge opportunity to market. So industrial ones, I don't need to reduce them a lot. I'll keep this short. This is a very secured portfolio, and this is something in which they are going to invest more. This is something that will change their multiple. Now, in order to invest more into the industrial one, they entered into another type of industrial real estate. That's called IOS, Industrial Outdoor Storage. I think Peakstone is the only public entity there with the iOS portfolio. iOS has huge barriers to entry because not many municipalities now are allowing these companies to open and operate iOS. So there's a barriers to entry. There is very little capital requirement. There is, I think, 20% building, like 80% land and 20% building. So that's the ratio there. Not much maintenance capex there. And then there is, these facilities are very critical to some of the companies' supply chain operations. For example, say Amazon. Amazon needs to deliver the products. They need to store them somewhere. So these facilities serve as a checkpoint for a lot of these supply chain intensive companies. Also, this portfolio has a huge uh, mark-to-market opportunity. It only has a vault of 4.5 years. Although this portfolio was acquired at only 5% cap rate, which is a bit too tight, but there is a 70% mark-to-market opportunity here, and we've seen how much the premium can be when you release these sort of properties. So at the end, we think that the target cap rate was a lot higher, like probably a lot lower actually. So I think they will be able to achieve their target cap rates because of this mark-to-market opportunity. Now, all in all, we had a very strong office portfolio, an industry portfolio that is going to be the future, and then iOS, which is just a new ball game for all of these companies. Just one of the best investments I think any industrial REIT can make these days. So that's why we believe that it's a very good opportunity. Why was it beaten down? Because of the uncertainty. The new acquisition always brings more uncertainty. When they bought iOS, even though it was a bit costly, I'll agree to that, but it seemed like a very good opportunity for them to grasp and to lower their reliance on the office portfolio. Also, a lot of people question about their buybacks. They might have done the buybacks, yeah, but given how leveraged they are, they cannot afford buybacks too much. It will increase their leverage ratios and might hit some debt covenants as well. Who knows? So, because of all of these things, I think Peakstone in some time will realize its true potential, and the market will realize it it to be a true industrial REIT.